Hello and welcome to the weekly financial market review, brought to you by LiveSquawk News. Over the next 30 minutes, if we can cram it all in, my guests and I will break down the key stories of the week gone and look at the implications for the markets. We'll also preview the week ahead, providing you with a heads up as to what you should be looking out for. It's been a very long week, and next week looks to be just as protracted for all of us. So let's get on with it. This episode, I'm joined by two seasoned market men who know their stuff. So I'd like to give a warm welcome to Ryan Littlestone of Forex Analytics and Michael Brown, market analyst at Pepperstone UK, the spread betting, CFD and Forex trading broker. Hello and good afternoon to you both.
Very good afternoon to you, mate.
Just the record, we're recording this on the Friday the 13th of March, and we've just had the US personal income, personal spend PCE data out as well about an hour ago. So we'll have a look at that in a bit. But before we get into it, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, consult a financial market analyst or professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Right, with that out of the way, let's crack on. And where to start? Well, I think we all know where we can start on this one, and that's the Middle East conflict that is currently ongoing. That's been fought as much in the air and on the ground as it is with social media posts, it would seem, from the bizarre to the ridiculous. But we'll have a look at that. So I'll start with you, Mike, on this one. The longer it takes, the harder it'll be, is what I put down here. And by that I mean, the longer this goes on, the more protracted it is, then the higher the oil price, you would assume, and the more damage it's doing to global trade from points we will get onto on the Strait of Hormuz. How do you view it at the moment? And I think, yeah, go on.
Well, I was going to say, I think that's a good way to frame it, actually. I think slowly but surely, as we've moved through last weekend, where there was no sign of any kind of de-escalation or any off-ramps being taken, and as we've moved into this week, I think there's been a kind of realization among market participants that this isn't Venezuela, for want of a better word, where this isn't necessarily going to be, over in a matter of days. It could be relatively prolonged. And I think it's a market that is sort of slowly but surely waking up to those supply disruptions that are going to dominate the energy space. Obviously, we've had this grind higher in Brent and WTI throughout the week, and in gas prices, as well as we've had continued attacks on shipping in the Strait of Hormuz, which is effectively impassable at this point. And markets elsewhere have just demonstrated an incredibly tight correlation with crude. If we see crude rallying, then that's a greater risk premium being priced. Stocks come lower, treasuries sell off, etc. And the opposite is true if crude rolls over. But I do think we've seen throughout the week participants kind of pushing out their expectations as to how long this could all go on for. I think we're effectively 2 weeks in now, and I think participants are very much of the view that we're probably going to have to measure it certainly in weeks as to how much longer there is until this comes to some sort of a resolution.
Yeah, I think the optimism that we were going to get this over in days is obviously been miscalculated by many out there. And although I think Trump has said it's a number of times, I think he said it a couple of days ago that he thinks we're nearing the end. It doesn't look that way, does it, Ryan?
No, and less the market's not buying into his BS about how they got things covered. How they originally started saying that the strait wasn't closed or wouldn't be closed. Now it's closed. He keeps coming out with these "we're winning" stuff, and the market's saying, "No, you're not. This isn't tariff messing around. This is really big stuff." And I think for markets wise, we're probably in the most dangerous type of situation. We saw the toys getting thrown out the pram in oil. that ramp up to $120 and whatever last week, that volatile move. But now we're at that point where the market is coming to the conclusion this is going to be dragged out, and that's when we could see oil prices grinding higher, going through that 120 even. The dollar continuing to be bid up. You know, we could see the euro moving right down 112s, even more, if this continues to drag on. Obviously, we could get some volatile headlines, and you're going to get spikes and dips and whatnot. But this is where the pain might really start coming for markets.
Yeah, I think oh, sorry, Harry. I was going to say, I think the other thing that markets are really kind of starting to wake up to, but also having really a lot of trouble digesting, is that the range of outcomes is incredibly wide. I mean, I think us three could sit here, and if we had the time, we could probably justify any scenario from this ends this weekend to this is still going on in 6 months, 12 months time. And I think the other issue with that is not only do you have such a huge distribution of outcomes, you've also got essentially ever-changing comments from the guys in charge, from the White House. 1 second Trump is going, it looks like this is nearly over, we're ahead of schedule. Then in the next breath, it's we're going to hit Iran hard, we're going to hit them harder than we've ever hit them before today, etc., etc. So the market is understandably having real trouble in trying to price a sort of concrete or definitive path that this follows, because there's so many paths that it could follow, and with every headline that crosses newswires, it looks like we're going to take a different one of those options.
Yeah, very good point there, actually. And as such, I think we've seen some of that reflected in the market volatility of late anyway. I know we tended to calm down a bit, but as you said, Ryan, we are following oil price around. That seems to be the major indicator. I want to move that on to the next point. Well, look, listen, this Middle Eastern conflict will weave its way through the whole of this episode anyway, so we'll come back to points. But US inflation data this week, obviously overshadowed by ongoing events in the Middle East. We had PCE data out today. I think the core PCE on the month was up 0.363%. Unrounded, up 0.4%, unrounded 0.363% versus 0.4% expected. What are your initial views on that, Mike, in terms of what we've seen on the inflation front? Obviously, we had CPI data out earlier this week. It's been a bit of a mixed bag, I think. But as I said, the reason I say it overshadowed is because of what we're experiencing, what we're seeing on the news screens at the moment with the Middle East, and this is old data in a way, isn't it?
Yeah, it is. I mean, the CPI numbers reference February, and they were banging line with where we were in January. 2.4% on the headline on an annual basis, 2.5% on a core basis on a year on year. The PCE numbers are even more out of date because they reference January, and there's various technical factors as to why PCE is higher than CPI. A lot of it relates to the assumptions that the BLS made in the shutdown last year, when they basically assumed prices in CPI didn't change at all in October. So that's skewing that one lower. The other thing is that shelter has and rent has about half the weight in PCE than it does in CPI. So that explains the divergence between the two. But frankly, and I know Ryan may take issue with me saying this, I'm not sure either of them matter especially much, because all eyes now really are on how high are energy prices going to go, how long are they going to remain at these relatively high levels, and what is that going to do to inflation? How high is that going to push headline rates of inflation? I was looking at CPI fixings in the United States, which, for anyone unaware, it's basically a contract you can trade as to where inflation's likely to be. At the moment, the CPI swaps put March inflation at 3.2% for headline CPI, and they see it peaking about 3.5% in June. So I think that's really the market's focus now is, we know that there's an energy price shock coming. What is the scale of that? What is the magnitude of that? And I know we'll get onto this in a while, but then following that, how do central banks deal with it, and what does the reaction function look like?
Yeah, I mean, I heard from central bankers before we heard from experts, I think, talking about it's inflation expectations that are the real problem here in the short term, in the early part of this conflict, where obviously oil prices are spiking, but if they're not sustainably high for a period of time, then it can be worn, and it won't feed into inflation in quite the same veracity. So it's inflation expectations. Ryan, as a trader looking at this, where'd you go from here?
You've got to look at it in two ways. Firstly, as a snapshot of where we are now. So let's say we didn't have the problem with Iran going on. You look at that data, and it's going to feed into what you expect from the Fed next week. Right now, are the Fed in any position to cut rates on the data currently? The answer is probably no. Now, they can look through any inflation blips as they like. Again, it depends on the duration. If this thing is over in 2 weeks, then it all washes out pretty quickly. And we then can look back at this data and say, well, the Fed are still not in a position to cut rates yet. So that's how you view it on one hand. Obviously, the longer it goes on, the more second round effects it may have, and it changes the picture further out. So trading wise, purely from a trading standpoint, I just use the data to see if any particular data point kicks the market out of sync with what the trend is of the day. At the moment, the dollar's getting bid up pretty much every day. So if you get a data that sends the dollar lower, I look at it as a potential dip buy for an intraday play or something like that. But yeah, the data still remains important because it just keeps that underlying view of what's going on in the economy. We had GDP today as well. It wasn't a good number in the first release, 1.4%, and it halved in the first revision. So that's not good news. We've had flat retail sales for the last 2 months. That's not good news. We've had that wobble in the jobs market as well. Net 45,000 across the last 2 months. A little bit softer potentially than what we've been getting. So there's some little signals that there is a bit more weakness coming in. Very small. The economy is still ticking along. That GDP's probably got a lot of skew in it, but we're not long from finishing up Q2. And if Q2's another wobbler, then the market is going to be thinking, okay, what does the Fed do? Does it keep rates steady if there's an inflation blip from this Iran stuff, or is it going to get quickly back to looking at cuts because the economy's maybe wobbling a little bit?
And that's the other side is, I guess, is the degradation to growth because of activity, and the price of certain raw materials potentially in the short term go up and just stymie the ability for certain industries to operate efficiently. Is still all to play into it. As you say, some second and third round effects are still yet to be sort of properly theorized, I guess, or play out.
Yeah, I mean, this is something I've mentioned today and recently. Obviously, without getting too much into the central bank thing, we've had a lot of this, headline central bank hike expectations rising for the ECB and whatnot. But we're not in 2021, 2022 where economies can wear higher prices and pass those along. Look at UK growth, 0% today. We're not in a situation where firms can get away with hiking prices. And that means that if they have to wear that, it's going to hit margins, and they're going to look to cut costs. And cutting costs means cutting jobs, lowering wages. Yeah. So we're in a completely different situation. So central banks are going to be in the position not being able to hike on higher inflation, but having to potentially cut on the hit that the economies are going to take.
Yeah, I think that this is where, I think the market has almost drawn the wrong conclusion from what we're seeing. And we were actually discussing this earlier, Ryan, in your room, where, the market on the whole, if you look at how, curves have moved this week, we've now got barely one rate cut priced in the States this year. We've got basically nothing priced for the Bank of England. And I think for the ECB, the market's pricing about 40 basis points worth of hikes. There seems to be this assumption that, we're going to go from energy prices move higher, which means headline inflation moves higher, which is correct. But automatically, that means that we're going to see central banks adopt a tighter stance and begin to raise interest rates. But actually, that's not necessarily the case, because as Ryan just alluded to, this energy price shock is happening, certainly in the UK, into an economy where growth is already pretty anemic. The labour market globally, I would say, the employment backdrop is relatively fragile, and there's quite a lot of slack in terms of global labour markets in developed markets. So when you're asking yourself the question, yes, we are going to see headline CPI move higher. Let's not dispute that. Is it going to be sustained at that higher level? I really, really struggle to see the case for that, and would actually argue that this is, if the rise in energy prices is prolonged, it's much more likely to be detrimental to demand than it is anything else.
Again, another good point. Yeah. Ryan, did you want to come back in on that?
No, I completely agree. And it could be a case where, we've got energy inflation, but disinflation underneath, in those second round levels, if you like, where firms are cutting costs and getting rid of staff and whatnot. And then you're in the potential stagflation situation.
Yeah, just very quick on the US GDP. It did come in at 0.7%, half of the 1.4% estimate expected for this revised read. Year over year was a 2% growth rate in there as well. Consumer spending was revised down to 2% from 2.4%. Personal consumption annualized at 2% there on the quarter. Turning to, we've done UK growth, so we'll gloss over that to a degree. Underlying strength is dissipating. I think a number of houses have now revised lower growth estimates to nearer the 1.2, 1.3% level from 1.6, 1.5 that some are looking for the UK economy. We're already struggling really with insipid growth rates, and this isn't going to help the situation. So one to watch there. The Bank of England, like we said, we'll come on to the central bank decisions, but Bank of England is one of those banks that will report next week. It was in some quarters it was expected we'd see a rate cut, but again, that seems to be off the table in terms of market pricing now. Again, another byproduct of what we're seeing at the moment potentially, and as the famous Warren Buffett says, you only see who's wearing shorts when the tide goes out. Potential private credit crisis. Is this something to worry about? I know it's a big question, and we're at the start of it really, but you're starting to see a couple of stories out there. I think Blue Owl was one a couple of days ago that I think was closing one of its funds, or its main fund. Not massive, but again, are we starting to see any signs? Is this a canary in the coal mine for private credit? Michael?
Well, I know exactly what you're angling at here, because in 12 months' time, there's going to be a clip of me somewhere when this all blows up, when I'm eating humble pie, saying this was never going to be an issue. But I'm going to say it anyway. I don't think it's a systemic thing, simply because from the sort of reading I've done into it, it doesn't appear as if private credit is actually big enough at this stage to pose an issue. I know people are naturally drawing parallels with 07, 08, etc., but it does seem somewhat different. I know it's risky to say that. I think really what we're seeing is almost a feature of private credit as opposed to a bug of private credit, which is that everyone is, well, not everyone, but there has been a massive increase in redemption requests from these funds, and that's simply just a reflection of the broader risk environment. You're looking at European equities down 10% or so, equities on Wall Street down 3 or 4% since this began a fortnight ago, etc. We have seen a broad desire to take down risk levels, and it's not really surprising that people are trying to take down risk levels in terms of their allocations to private credit as well. Yes, there's a few kind of idiosyncratic issues around potential bad loans and all that kind of stuff. Obviously, we had, actually, I think we spoke about it last year with First Brands and Tricolor and that kind of thing. It's one of those where my sort of hunch at the moment is it makes a sexy sounding headline for financial media, but I really don't think it's a significant concern at this moment in time from a sort of broader financial stability perspective.
Well, that's a boring answer. I'm going to edit that out and just say yes. That's not what we have on this show, Mike. So please, come on, play up.
Everything's going to blow up tomorrow. There you go.
I don't mind going into that one. I think where you've got to watch is the technology sector. I mean, Michael's fond of his blue elephant on Twitter. You know, the amount of private credit going around in there is just beyond belief, and it's got to be justified. Now the market's happy to justify it at the moment in terms of, you know, what tech companies can do and chip companies and all that sort of thing. But when you've got the likes of Amazon lending money to OpenAI, who then buys its stuff off it, and the same with the chip companies, you've got to ask some questions. How long can that carry on for? And I think that's probably, I wouldn't say it will be the trigger for all private credit, but that will be where I think if anything does go pop a little bit, that's where it will go.
Yeah, and as my inference was that this could be just the start of a domino effect, and it brings on a crisis in another sector at a time when, you know, where you've got inflated, you could say inflated stock prices. Some might say no, but you could say that, and we could start to see this cascading into other sectors. So it was just something to you know, he's poked his head up this week. It's a topical conversation, so I thought, why not poke the bear and ask you guys about it.
I do think it's an important one, though, because you know, it's things like that, and things like you know, the whole AI theme that Ryan touched on, and what that's doing in terms of productivity and all that kind of stuff. That, you know, basically think back to what we were talking about this time last month. None of those themes have really gone away. They've just been massively overshadowed because we're suddenly laser focused on, you know, the next $10 in crude and what's going on in the Middle East. But these underlying economic developments are still bubbling away under the surface, and I think it's important not to lose sight of that, because, and I think Ryan mentioned this earlier, once we do get through the present turbulence, which, you know, obviously touch wood, we hope that's sooner rather than later, that they will be the issues that the market and we all kind of refocus back to.
It's not going to be a problem, is it? I mean, the central banks have got us covered. They put everything in place that things like this wouldn't happen again, you know, 18 years ago. So, yeah, it's not going to be a problem, right? Right?
I sense a little bit
slightly
of
sarcastic.
Me never.
But I get your point. Right, let's move on to the week ahead, because there, as I noted at the top, there is quite a lot out next week in terms of central bank activity. We're not going to cover everyone, but I think it's worth noting there's at least 8 or 9 major central banks reporting, obviously headlined by the FOMC next week. Okay, I'll start with you this time, Ryan. We're not expecting any change from the central bank. I know there was talk that we could see 2 hikes this year, as inferred by Mike. That's now been sort of blown out really effectively by what we've seen with the conflict. So next week, Dud, how can he, you know, it's quite hard for Powell, again, the outgoing central banker, to really navigate his way through this, really, because it's a moving feast in terms of the situation that's happening at the moment.
Yeah, I think Powell will navigate it as well as he has done during most of his tenure, and I think he's going to face all the questions. Obviously, what are the Fed? Are they going to hike if inflation picks up and all this sort of stuff? And he's going to have to walk that fine line as normal. You know, without going massively into it, I think he's going to have to navigate the Warsh questions, whether he's going to stay on. Going to have to deal with the forecasts. Is that going to reflect any Iran impact at all? The ECB have mentioned their forecast may partly reflect some of what's going on. I think if there's one thing I'm sort of keeping in the back of my mind that they could comment on, is potentially QT, if this Iran situation develops into something that's going to meaningfully impact the economy. I think that might be one of the things they can potentially move quickly on, that will be easing, but not a rate cut easing, or even going the other way if they need to tighten for any reason. So that might come up, but otherwise, I think Powell's going to have to tell the market that he's got it covered if anything does go awry, and not to worry about it. And but yeah, I think I mean, if I was Powell, I'd be like, I'm leaving in 3 months. It's all yours. Have it, Mr. Walsh.
Nice. There's a note here from TD Securities says they're revising their Fed call and do not expect another rate cut now until September, as the Fed assesses the recent developments in Iran and awaits for further inflation normalization. Rates are currently at 3.5 to 3.75% window at the moment. They also say the labour market remains in an on net solid place, while inflation progress has stalled. We expect the SEP to see upgrades to the near term to the dot plot medians. Chair Powell is likely to maintain optionality with regard to the recent geopolitical developments, noting that policy is well positioned to dual-sided risks. Now, because I want to get so many in, Mike, do you agree or disagree with that statement?
I agree with it completely.
Right. Well, you can have the next one then. Well, you can next two. Obviously, we got RBA and we got Bank of Canada this week as well. The RBA is in a hiking cycle is probably too preemptive to say the least, but we are expecting I think further hikes. We were expecting further hikes this year from the RBA. Anything insightful that you have on that, or what do you reckon on that one?
No, I think you are actually right to call it a hiking cycle. Obviously, they raised rates at their prior meeting. We had some hawkish remarks from a few of their policymakers recently. Hauser and the governor, Bullock, were sounding relatively hawkish. Pretty much all of the local Aussie banks are now calling for a 25 basis point hike in March. The market's only priced that at about a 60% chance, but I think it would be very, very surprising if they didn't deliver that. And I think they're likely to guide towards more tightening going forwards. The RBA are in a bit of an awkward position because, in contrast to most other G10 central banks, where inflation either was at target or sort of steadily declining towards target before the recent move in energy prices, inflation in Australia was moving in the other direction and the labour market was relatively tight. And now you've got another upwards inflation impulse on top of that. So I think in many ways the RBA have got, well, frankly, little choice but to tighten policy, again, to try and ensure that those inflation expectations we alluded to earlier remain relatively well anchored.
Nice. Well put. Bank of Canada, then we're moving on. Again, as I said, we've got a number of these to go through. Bank of Canada, do you think they're pretty much in the same position? I'll stay with you on this one, Mike. As the US, will wait and see mode at the moment. I think labour productivity, I think, slipped a little bit in Q4. I think the economy as a whole is looking a little bit soft at the moment, but I don't think they were before this conflict in any mood to sort of move too quickly on rates. Any views on Bank of Canada?
Yeah, I think actually the BOC are just going to be kind of the boilerplate that everyone else is following, along the lines of we're going to wait and see what happens and move policy as appropriate. The complicating factor is today, about 90 minutes ago, we had almost as disastrous a labour market report as you can imagine. Unemployment up to 6.7 from 6.5% previously, and the economy losing 84,000 jobs in the month of February. So again, I know data isn't really a major market driver at this point, but the Canadian economy doesn't look like it was coming into this on the greatest of footing as it was, which again kind of helps strengthen the idea that actually the BOC probably should look through any temporary rise that we see in CPI in the months ahead.
Yeah, I mean, just some notes here. So net change in employment, like you said, fell by 83,900 from expected rise of 10,000. Full-time employment change was down 108,400. Previously was up 44,000, nearly 45,000. And the unemployment rate, as I said, 6.7% from 6.5 last. 6.6 was predicted. Ryan, do you do much in the way of the loonie?
Yeah, I trade the loonie quite a lot, and that was an absolute stinker of a report. The Bank of Canada is a bank that can sometimes move a bit with the data tides. So I wouldn't be surprised if they were. I won't say they're going to be dovish, but unhawkish about that
He's
jobs
making
data.
these up as he goes along now.
Here we go. So yeah, I think they'll be a bit worried about that jobs number because it's the second negative number we've got on the trot. So they might be worried that a trend is starting to develop. So yeah, I think they'll stay middle of the road, but I think there might be a bit of a bearish tone to their comments.
Okay, we'll slide over the Brazil Selic rate. The Swiss National Bank, because it's quarterly, we'll give a little bit of time to this. We saw inflation data, I think, slightly exceed expectations at 0.1% from flat. We saw core inflation at 0.4%, which is in line with Q1 forecasts. Note here from Danson said that inflationary pressures remain subdued and should keep the S&B on its toes for the time being. It's only further amplified by the recent strengthening of the Swiss franc. Now, obviously, I think as a FX trader, predominantly the Swiss franc is one of your key, I guess, instruments to trade around. So, Ryan, what do you make of the Swiss National Bank?
Yeah, I think they've got a bit of a reprieve with that inflation number because obviously everyone's still wondering if they're going to go negative again with rates where they are. That's their next logical step. They're keeping it in the toolbox. I think that inflation print keeps that wall from the door for a little while longer. We do have suspicions that they've been smoothing the Swissy of late because obviously that took we saw Swiss pairs taking a big old hit on all the risk stuff, as you'd naturally imagine. And the fact that has stopped dropping, or Swiss pairs have stopped dropping for now, suggests that they might have been in with a bit of a smoothing hand. Otherwise, I think they've got a steady as she goes approach as well. Keep the threats on the table, FX intervention, and going negative. Keep the same lines, really, and they can move on and see what happens in 3 months.
Okay, fair play. We'll crack on then. So we've also got Swedish Central Bank rate decision, Riksbank interest rate announcement coming up next week, as well as the S&P, which I'll put twice just to re-emphasize. Bank of England, and we've covered this a bit when we were looking at GDP. I mean, we're not expecting anything from them. Maybe the voting pattern is something to look at. Mike, I mean, we've had the last two decisions have been close ones. We were 5-4 split. This time around, it should be a bit more unanimous. Do you not think? Because of the situation.
Yeah, absolutely. I'd certainly expect it to be, and actually, I would say you're probably looking at something along the lines of a 7-2 vote this time out. Taylor and Dinger would probably dissent to hold bank rates, to deliver a bank rate cut. Everyone else in favour of holding steady. I think the BOE will probably really try and play for time here along the lines of, they've got a forecast round coming up at the April meeting, so I think they will just stress that again. They will wait and see what happens. They'll act as appropriate, and they'll have a more thorough assessment of how the economy is likely to evolve in about 6 weeks' time when they come back to us on the 30th of April. The one thing I do think will be interesting with the BOE, when they introduced this, I slagged them off for it, and I'm now going to say it's actually going to do us a favour. But in the minutes where each of the MPC members now gets a paragraph to explain their views, I think that's going to be quite instructive because it will help us to gauge who on the MPC is worried around potentially embedded inflationary pressures and seeing a need to alter the policy outlook and stay tighter for longer as a result of the move in energy prices, and who on the MPC is prepared to look through it as more of a temporary thing, and I think that's going to help us gauge the policy outlook as we move forwards. But I think the BOE, it's very much going to be a case of we're ready to react if we need to, but we just need to wait for more information before we do.
Just so why was that a bad thing in your eyes, like for them just to give a bit more insight into their decisions?
Because he loves moaning at them about this sort of thing.
No, it's not that. It's more a case of just too much information for markets to digest for no apparent reason. And now it's actually going to be quite useful. So, Mr. Bernanke, fair play, well done.
Well, again, this has always been one of the things I've sort of railed against with traders, that sometimes it's not for the markets, it's for the public and the general public to understand better monetary policy and the way things work and what they're thinking of, because there's this massive information gap, black hole really, between what the MPC and what any central bank says and what the public actually looks at and views and understands. And so I think, in my opinion, that's what they're trying to achieve with this. And the markets sometimes can be a bit of a byproduct. I mean, they generally talk to the people they need to talk to behind the scenes to convey their message, I think. So that was, my 2 penny worth on that one anyway. A number of banks have also delayed their any cuts now to, I think Bank of America looking at June, September time, assuming energy price moves reverse in the next couple of months, they say. There's no assumption we can make on any of that at the moment. So there we are. ECB is a far more, I'm going to say, straightforward event, but we shall see. Ryan, ECB next week as well. Any views on? I mean, they're expected to keep rates on hold. I think that's that's a given. But any views on the ECB and what they may have to say?
Yeah, I think they're going to talk both sides of the risk event that's going on. Going to be attentive to inflation if it goes up. Going to be attentive to the economy if it suffers because of it. They continue with the victory laps. They got inflation where they want it. They got rates where they want them, and there's no need to go either way. And as always, as I say, Lagarde will try and walk that middle line, probably confusingly, like she always does, talking about probably tides in the sea and whatnot. Overall, I think it's probably going to be a nothing burger, but we should still look out for any comments that they may have to react if things further develop on the Iran situation.
So go on.
Oh, sorry. I was going to say, I think the other thing just to bear in mind with the ECB, Ryan sort of touched on it earlier on. If they follow their normal practice, the market assumptions in the forecasts will have been taken about 3 weeks ago. So effectively, there's a real risk that whatever the ECB put out in their projections is out of date the second that it hits newswires. So just be a little bit careful with that one. If the projections look obviously wrong, i.e. the inflation profile isn't revised a lot higher, then that's probably what it is. Yeah,
and I think this market hike expectations that we've been seeing, 2 hikes priced this year, that sort of thing, she may push back a little bit against that, or she'll turn around and say we're not listening to it, it doesn't mean a thing.
Yeah, good point. Just note, JP Morgan have put a note out. Greg Fuzesi here says the staff will present updated macro forecast. The cut-off date for the technical assumptions on energy prices would normally be before the start of the Iran war. The staff can, however, either push this back or supplement the baseline with scenarios. One way of gauging how the ECB may assess the impacts of the Iran war is to look at sensitivity analysis its staff carried out back in December 2023, and it goes into that as well. But yeah, fair enough. Right, Bank of Japan we have as well next week as we come to the end of this central bank show. We know they're on a hiking cycle for sure, however long it might take to get where they need to get. Has this sped things up? I mean, again, there's so much uncertainty out there, but we do know for certain that they want to raise rates at least once or twice, I think, this year. So, Mike, Bank of Japan, do you see them going this time round, or just send more signals that it's incoming?
Yeah, I'd be very surprised if they went this time around. I mean, chiefly, we haven't had any indications. We know the Bank of Japan love a sources story in the media, and all of them indicate that it's April that's really the next live meeting. And again, they're going to be in this kind of wait and see mode of we want to know exactly what's going to happen or have a greater degree of clarity in terms of what's going to happen on the geopolitical front before we pull the trigger on another rate hike. But as you rightly rightly say, we know the Bank of Japan have got a tightening bias anyway. If you do see headline inflation moving higher, that's going to give them more ammunition to deliver those rate increases. The other thing to bear in mind, again, we've kind of forgotten about it a bit because of so much focus on the Middle East, but the spring wage negotiations that they like to pay very, very close attention to, and they'll have more information on that front by the time of the April meeting. So markets at the minute give about a 2 in 3 chance of an April hike. I think that's probably a little bit underdone. If they, well, they're certainly going to signal again that if the outlook is realised, they'll raise rates, and it certainly wouldn't surprise me if they moved at the next meeting on the 28th of April.
Thank you for that, Mike. Ryan?
I'm not going to say the chances of a hike next week are 0. I've been making this point today in our chat room. They're in a very, very sticky situation with all this Iran stuff being such a huge energy importer. They're facing a double whammy where dollar yen's rising and the price of oil is rising, so it's almost costing them double. I think if that continues, if we get a blow up there, and I'm talking if oil's back above 120 by next week and dollar yen's trading north of 160, that sort of thing, it might be something that the BOJ act on, not as part of normalising policy, but as a message to say, if anything happens here, we're going to keep on top of it. Because a 25 pip hike, it wouldn't make a blind bit of difference to the picture in reality, but the message that might send changes the picture a little bit to say, yeah, we're gonna, if we need to act on outside forces, we're ready to do that, not just what's going on in Japan. Otherwise, if we didn't have this Iran stuff, yeah, same as you guys, no hike next week, wait until April, turn over the fiscal year, which is happening as well, and carry on as normal.
I mean, they are extremely accommodative at the moment, so that has to be said for Japan. Again, another note from JP Morgan, this time Ayako Fujita says, we expect the BOJ's message to be, the BOJ maintains a normalization path and will assess uncertainties related to the Iran war before deciding on a hike, and will not raise rates amid market instability. This would not pre-commit to an April move, while keeping the option open if conditions stabilize. Ryan, as you were saying, in practice, the degree of stabilization is likely to be judged against prevailing yen pressures into the meeting. So the currency obviously is going to play a very key part in that. And again, the situation remains fluid, shall we say, on the international front. We also
that might be the understatement of the week there.
The situation remains fluid. I don't know. I think that quite aptly sort of sums everything up. PBOC have their loan prime rate, 1 year loan prime rate decision to come as well over the weekend. Activity for the Chinese, obviously, they're oil is a key component of their prosperity, and we've heard in days that, again, apparently Russian and Chinese ships have managed to get through the Strait of Hormuz, but probably nowhere near the margins needed and the amounts needed to continue to underpin China's manufacturing sector. So just quickly as we finish off the episode here, should China really be worried? They haven't really said anything or they haven't entered into this diplomacy with Iran or with the US. And I read something, I think it was in the Nikkei Asia, that suggested that she's in a bit of a hard place, a rock and a hard place, wanting to support Iran on one side, but not wanting to get on the wrong side of Trump and the US on the other for trade. He's in a bit of a dilemma at the moment, or the country is. Mike, would you say?
Yeah, they are in a bit of a tricky spot because, as you say, on the one hand, they want to keep Trump happy on the trade front. And obviously, we've got talks between Li Haifeng and Scott Bessent in Paris this weekend, actually, before that Trump-Xi summit that's due to take place at the end of the month, start of April, which, again, everyone seems to have forgotten about. But on the other hand, China gets the majority of their oil from Iran and comes through the Strait of Hormuz. So I do wonder whether we get to a stage where, again, if we're another 2 weeks down the line and flows are still disrupted, do China start to get a little bit more vocal about getting some tankers through and all that sort of thing? I don't think whatever the PBOC do matters especially much at this point. I think it's more of a fiscal story. It's more of a geopolitical story at this stage.
Yeah, fair play. Ryan?
Yeah, I think they're not saying an awful lot publicly, but you can bet they're saying stuff behind the scenes. But regarding the rates, we've got the LPR rates. Officials mentioned that they are potentially looking at further rate cuts this year, first half of this year. I think that's probably a bit off the table, given the latest inflation numbers and general data. So I don't think we're going to get anything there. They threatened it for pretty much the last 6 months of 2025 and didn't end up doing anything. So I think that's probably off the table. And yeah, we look forward to this weekend, see what that leads to regarding trade and what this is going to mean for the Xi-Trump meeting later on.
Like you say, it could become quite pivotal in terms of what China can do to try and bring this conflict to an end on their side and what pressures they can bear on both sides. I think in terms of inducing the US into trade and into whatever the US wants out of things. And
it was only a couple of weeks ago they were doing naval drills with Iran and Russia around there. So to say China's not got a hand in anything or has been quiet about it, as I say, doesn't mean they're doing stuff under the table.
No, absolutely not. No. Listen, guys, we've run over time, and there was never a chance.
No, gutted. We've lost out on our beers, Mike. He promised us beers. It's under 30 minutes.
I think that was always a banker for him, wasn't it? To be honest.
Yeah. Typical broker.
Yeah. Well, there you go. Wide prices. Listen, thank you guys for participating today. Obviously, we had a lot to cover, and I think you've done it really well, done it justice. So thank you very much, Michael Brown of Pepperstone UK Brokers. Thank you.
Oh, sorry, I was talking to myself. Thank you very much for having me. Good fun as always, mate.
Awesome. And Ryan Littlestone there of Forex Analytics. Thank you for your participation today.
Thank you very much, mate. Pleasure as always.
Also, I think people got a lot out of it as well, listening to you two. So much appreciated. Anyone who missed the start of this can go back on the socials and start from the beginning or on the podcast platforms as iTunes or Spotify, so forth. So please have a listen in its entirety. Thanks again, guys. And listen, have a great weekend. Obviously, we were watching the news to see any major developments, but as it seems at the moment now, this thing is going to roll into week 3. I think we're in week 3, aren't we? Can I say that? Yes.
It will be, after tomorrow.
Yeah. So, let's hope for a swift end. So, thank you very much. Everyone stay safe, and we'll see you again next week.